Equities all falling more than 1% this hour. Trade tensions are escalating between the U.S. and China as the Chinese delegation is slated to arrive in Washington today for the latest round of talks. With us now is David Rosenberg, Gluskin Sheff, chief economist, and Krishna Memani, Oppenheimer Funds CIO. Lucky to have you both here in person. David, does it matter to the markets whether we get a deal this week?
Well, I think for the here and now, it certainly does matter. I mean, I guess we can always have a situation where the talks get extended. But remember that the markets were pricing in just a week ago that a deal was going to be in the works for this week. So I think that what this affects, maybe not so much earnings, because if they raise tariffs, obviously that's going to have an impact. But right now, it's the extended uncertainty is going to have an impact on the market multiple, and that's what's happening right now. So I just think it's the heightened uncertainty. Maybe a week from now, we'll get a deal, or maybe not. But it's the fact that the markets had been pricing in something happening by tomorrow. That hasn't happened. We're not getting the deal that quickly.
And it looks less certain by the day, especially after a rally cry from the president like that. They broke the deal. It does appear to be an issue for earnings in the economy as well, though, David. I mean, if we do see those tariff rates go to 25%,
right? Who
pays for that?
Right. Well, I mean, China will pay, and consumers and business in the U.S. will pay. It'll be mutually shared pain. I think that if we go this route and you do the bean count in terms of the U.S. putting on the tariffs, China retaliating, you could probably shave about 0.5 percentage point off U.S. GDP growth. It's probably more like 1.5 points in China. And you trace this through, what it means for earnings. It's at least a 3% hit on S&P earnings. And then you got to factor in the multiple. That's always the elephant in the room. And my sense is that if we end up getting this situation where there's a trade war, in my opinion, it's at least a 10% hit on the stock market. And, we're about a third of the way through just in the past couple of days on that score.
Krishna, let's come to you on that. If, in fact, we do get to the point where we're 25% on the $200 billion and even perhaps on all of the imports from China, what do you see the hit economically, both here in the U.S. but globally?
I think David's numbers hold. 0.5% probably for the U.S. and 1.5% for China. Those are the IMF estimates, and I don't have any reason to quarrel with that. The real issue for us really is, let's say we have the 10% market correction that that David was alluding. What do you do after that? Once you have that correction, my point would still be that growth in the U.S. and growth globally is going to be relatively stable. I mean, it's not going to be at the same level as it was before, but it would still be relatively stable. And one other thing that we have to price in that context is, what does the Fed do when the growth starts slowing down because of tariffs? And the likelihood of a rate cut comes forward, and the immediacy of that increases meaningfully. And that, to some extent, will support the markets. Remember, we went through a lot during this cycle. We have gone through Brexit, we have gone through debt downgrades, and we have come out of it.
We haven't gone through Brexit yet.
Well, we went through the possibility of Brexit, and I think that every day it looks likely. The point is, we will come out of it reasonably okay. It wouldn't be good. Growth will certainly slow down. From a longer-term global trade perspective, it's not a good outcome by any measure. But I think after we have the immediate down trade in the markets, probably for the rest of the year, it probably goes up from there rather than continues to slide down.
But Brexit is nothing compared to a trade war between the two largest economies in the world.
Well, I think Brexit is pretty important for the European economy as well. Again, not to the same level of significance. However, the fact that we have a tariff today doesn't preclude the likelihood of reaching some sort of a settlement in not too distant a future. Come back to the motivations. The motivations to arrive at a settlement are very acute on all fronts, including Trump, despite his brave talk, including China, despite their brave talk.
That's the best case for it. David, I know that you definitely disagree with the fact that you think growth is stable. You think we're going into recession?
I think that we're going into recession. Look, I'm not going to sit here and pinpoint the day, the week, or the month that's going to happen, but it's out there. I think people tend to forget that the cause of the recession are the lags between the monetary policy tightening cycle and the eventual hit on GDP growth. So, of course, we're talking about trade right now, but my premise all along is that there is no get-out-of-jail-free card after you've had a monetary policy tightening cycle like we had. When you count in the quantitative tightening and the 9 Fed rate hikes, the Fed tightened 350 basis points this cycle. And the only thing separating where we are today to the recession, which I think is going to be in the next year, just the traditional lags. David, we'd be sitting here in 2006 having the same conversation, and you say to me, I don't see the recession out there, and I'd be saying, focus on the lags, those lags between the Fed policy cycle, and it works in both directions. How did we get the recovery in 2010? All the lags that kicked in from all the Fed easing, the aggressive easing. It works in both directions. You either believe in the power of the interest rate cycle, take into account that the lags are long, variable, and insidious. They're between 4 and 8 quarters.